Peter Schiff's warning, this is a sequel to 2008, and like all sequels, it will be worse than the original. Dan Ball and Peter Schiff discussed the bank rescue, the developing financial crisis, the Fed, and inflation during Schiff's Real America appearance. He claimed that it will be worse than 2008. Peter referenced Senator Elizabeth Warren's assertion that the failure of Silicon Valley Bank and Signature Bank was caused by deregulation. Well, Peter's feelings is deregulation exists in the fantasy of her mind. It would be much safer if it was regulated by free market forces instead of government. Peter also noted the record high credit card debt. It's not a coincidence that both the borrowers and the lenders are broke. You know, the reason for this is the Fed. The Fed kept interest rates artificially low for more than a decade, encouraging people to go deeper and deeper into debt and banks to extend them the credit. Now that they're forced to raise interest rates, something that was always going to happen, they have created another financial crisis, which is something I've been warning about for years. Peter said the media doesn't want to call it a financial crisis. Instead, they call it a banking crisis. The financial crisis of 2008 was a banking crisis. However, nobody wants to say what it is because they don't want to invoke memories and comparisons to 2008. But this is a sequel to 2008, and like all sequels, this one is going to be worse. Peter argued that the Fed's decision to hold interest rates artificially low at 1% from 2002 to 2004 was what caused the financial catastrophe of 2008. The spread of adjustable rate mortgages, zero-doc loans, no money down loans, and various other bizarre lending strategies resulted from this. The real estate bubble was ultimately burst by this. Naturally, many of those loans defaulted as soon as the Fed began normalizing interest rates. It ultimately caused rates to reach a high of 5.25% in 2006. That sparked the financial crisis of 2008. The banking system was much sounder before we had an FDIC than it is now, because back then, banks had an incentive to be responsible because their customers held them accountable, but now there's no accountability. Schiff said the push to raise FDIC limits even higher is nothing but doubling down on a bad policy. It's just going to create a bigger moral hazard, but they're trying to undo the damage from the moral hazard they created by bailing out some banks and leaving the impression that some might be vulnerable. Now, they've created a run on solvent banks as people rush to put their money into insolvent banks. Where is the government going to get the money for this is the big question. That's just another unfunded liability that has to be piled on top of a massive unfunded debt on top of the funded debt that's unpayable already. So it's all going to be inflated away. That's what people have to worry about. Everybody's bank account is at risk because inflation is going to destroy the purchasing power of your money. It doesn't matter if your bank fails because the money that you deposited in the bank, that's going to fail.